Before we get into the episode, a quick reminder that the last trade is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Now for a word from Onramp. Onramp is a Bitcoin asset management platform built on multi-institution custody. We serve high net worth individuals, institutional investors, and financial intermediaries with a best-in-class suite of products, which include multi-institution custody, a spot Bitcoin fund, Onramp Wealth for RIAs, and private wealth services for high net worth individuals. Leveraging our partnership with BitGo and other industry leaders, Onramp's multi-institution custody is a first-of-its-kind institutional-grade vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. Our multi-institution vaults utilize cold storage, key signing, and authentication at the direction of the client to maximize security for client assets. This pioneering approach to custody is the foundation of Onramp's financial products, which reduce counterparty risk associated with trusting a single institution. To learn more about how Onramp can help you secure a new or existing Bitcoin position, please visit our website at onrampbitcoin.com, where you can schedule a consultation and connect directly with our team.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Gentlemen, welcome back. Short week. Recorded 6 days ago. Had Thanksgiving. How was everybody's Thanksgiving? Good holiday season?
It was great. I was up in the Northeast, so it's always nice being from Texas to get out of Texas climate to like actually feel a season or a holiday. So it was nice. It was like cool 30 degrees. So it was very, very fun.
Yeah, it was a great Thanksgiving. A little bit slow getting back into it, but going to make the most of this month before Christmas now.
Jesse had a Texas Thanksgiving. Is that your first Texas Thanksgiving?
Good question. I suppose so. First one since moving back at least. And I had my folks here and I had to do a bit more hosting than I had anticipated, I guess. But that's the holidays for you. And then you got to get back in the work swing.
Jesse, Marty, and I were chatting about we all have to get together and then maybe we just open a bottle of wine and have a live recording when we're all back in Texas together and figure out our fourth guest. Maybe they join us and just do a live recording session.
Hey, you had me move down here, Michael, and then you're never here. You're always in the Northeast.
Don't put that on me. I would like nothing more than to be in Texas, but when you have in-laws and the holidays, you got to figure out where to make everybody happy. So yeah, I'll be back soon enough.
Yeah, it was a brisk Thanksgiving down here in Texas. Nice relaxed one for me. The family came to us. I was in bed by 9:30, Wednesday through Sunday. It was a great relaxing Thanksgiving break. But alas, it's good to see that everybody had a Thanksgiving. We're joined by Joel Revill, CEO of Two Oceans Trust, and a pivotal member of the Blockchain Select Committee in Wyoming, which has created more than 30 groundbreaking laws around regulatory structure of crypto assets. Wyoming is probably one of the most forward-thinking states when it comes to Bitcoin and digital asset regulation. We're very excited to have you on the show today, Joel. Thank you for joining us.
Thanks. Great to be with you guys.
Yeah, I think just jump off to learn a little bit more about you, your career, before you ended up at Two Oceans and working with the state of Wyoming to push forward these laws. What were you doing before you got into this weird world of Bitcoin and digital assets, and what gave you the confidence to sort of jump in and put your reputation behind this asset class?
Yeah, thanks. Well, I grew up in Wyoming, so I'm back home in my home state. But I spent my first 25 years of my career elsewhere. I started in the investment banking group at JP Morgan, transitioned a few years later to investment management, where I spent the bulk of my career. Most recently, I was a portfolio manager at Citadel, and returned back to Wyoming in 2017 to, I guess, partly for personal reasons, and then also to launch Two Ocean Trust, based here in Wyoming. And it was during that time that I was pulled into the digital assets, and it was really, I would credit the state of Wyoming for that. The first foray into Wyoming's efforts was through the Blockchain Select Committee, which I was appointed to by Wyoming Governor Gordon, and have served on that committee for the past 4 years. And then, as part of Wyoming's forward lean into digital assets, Two Ocean Trust has received a novel no action relief from the Wyoming Division of Banking, allowing us to extend our qualified custody status from traditional assets to digital assets under state and federal law. So I've been sort of pulled into the world of crypto through both the public sector and private sector.
Yeah, and I think Wyoming's a very fascinating case, because in Bitcoin we talk a lot about jurisdictional arbitrage, and when that topic's brought up, it's typically under the context of international jurisdictional arbitrage, but it's become abundantly clear, particularly over the last 3 years, that there's interstate jurisdictional arbitrage within the United States alone. And you have two ends of the spectrum. You have New York, and particularly the NYDFS, putting out the BIT license, I believe in 2014, 2015. And it seems like Wyoming saw what New York did and said, hey, we think there's a better way to do this, a more free market driven way to do this. And so I guess that, whether it was a direct response to what New York did, or the recognition that regulation is needed to give people more clarity, what was sort of the driving factors of Wyoming putting their heads to their nose to the grindstone and really thinking about creating a regulatory environment that is friendly towards Bitcoiners and people looking to spin up Bitcoin businesses?
Yeah, I think there was elements of both of those factors that you mentioned, and then additionally, there's a couple of other factors. Something that a lot of folks don't know about Wyoming is that it's been a leader in a lot of areas. I mean, going back in history, Wyoming was the first state to allow women to vote, and that was done several years in advance of federal legislation around that. Wyoming created the first LLC. It's a little known fact. And again, years before other states such as Delaware adopted the idea of an LLC. So Wyoming tends to be on the forefront of a lot of issues. And a lot of these issues come from a desire to create opportunities for people to build businesses, create economic opportunities with a sort of libertarian slant to it, which I think kind of leads to the second factor, which is that I think Wyoming saw an opportunity here for an asset class that the benefits are very obvious. The reasons for the federal government to sort of squash innovation, or at least push it offshore, are obvious and somewhat frustrating. And so Wyoming saw an opportunity to step in under the right of a state to do so and begin to provide some legal and regulatory clarity.
Joel, that's really fascinating. I didn't realize that you grew up in Wyoming. Do you think that helped in your predisposition and like understanding Bitcoin, or from like a libertarian perspective? Because I was starting to jog my memory thinking of, like, at least in Texas, growing up here, seeing Texas be a leader along with Wyoming. In my mind, it makes complete sense, because this is just basically based in the roots of like you kind of the knowledge and the culture that has always been, that I've known. And so I'm curious, like, did that make complete sense when you moved back? It's like, of course Wyoming would embrace this technology because they've done everything else since I've lived here.
Yeah, it did. I don't know if that kind of personally has driven me towards the adoption of this new asset class, but I think it definitely makes sense for Wyoming. If you understand Wyoming's history and what Wyoming has done, sometimes where there's a void or a vacuum, Wyoming will step in. Sometimes it will be in direct response to something that Wyoming disagrees with that's being done elsewhere at a federal level. So it does make a lot of sense that Wyoming would be doing this. It fits with the DNA of the state.
Which is kind of in contrast to some of the other states that have taken the polar opposite approach to crypto in general. Specifically, New York is the most difficult state to do any kind of crypto business in because of their bit license requirements, and that stands out to me as really the opposite of embracing innovation, because they've already set up prohibitive regulatory requirements for allowing innovation to develop at all. So thank goodness there are Wyomings and Texases out there that are taking the other approach.
The other thing that's interesting on the contrast is like this whole proof of work. I remember, I can't remember if she did it publicly or privately, but Senator Lummis talked about the mineral rights and understanding kind of like that the scarcity aspect of it and having to manage that treasury and thinking about, well, where do you put your capital and to preserve wealth? And similar in Texas with oil, that there's this natural kind of understanding that there are finite resources on this planet and your state and the constituents tied to it. And to get that, like you might want to trade that for another asset, it better be as scarce or have some kind of value attributed to it versus what we know as, inflating away currency at this current rate. Yeah,
I thought that was a great observation the senator made, and it is probably no coincidence that two of the leading states, Wyoming and Texas, are come from a background and a context of commodities, and so that's I think there is something to that connection.
And to dive into the particulars of what Wyoming has put forth in terms of laws that embrace digital assets and make it a good place to do business, what was the approach for the committee when you guys first started out? What was sort of the landscape you identified, and how did you sort of break everything up into small pieces and begin to write legislation that enabled business to come to Wyoming?
Yeah, right. So the first thing that needed to be done was to define the asset, and then to codify that asset in our commercial and property laws. So there's been now over 30 laws that address digital assets generally. Probably the most important law early on was Senate File 125, which appended the Wyoming Uniform Commercial Code to include 3 new types of property: digital currency, digital securities, and tokens. That then kind of creates these definitions and this initial framework from which regulation can occur by the Wyoming regulator, the Wyoming Division of Banking. It provides a framework for the court. So one of the other new sort of initiatives that emanated out of this Blockchain Select Committee was standing up a new court in Wyoming, a Wyoming Chancery Court. And then it also allowed us to build additional legislation on top of that. And then as just maybe a couple of other key pieces of legislation, I'm sure you and your listeners are all aware of the kind of novel new bank charter that was created in Wyoming, a special purpose depository institution, or SPEDI, as it's called. And there have been several SPEDI charters that have been granted by the state of Wyoming. Of course, the Fed has not granted a Fed master account to a Speedy yet, and my colleague our former colleague on the Blockchain Select Committee, Caitlin Long, is the founder and CEO of one of those Speedies, who is now doing battle with the Fed over the master license. So that was a key piece of legislation that is sort of in suspended animation, awaiting movement from the feds. Wyoming also created the first DAO LLC, decentralized autonomous organization, and we continue to amend that legislation as we learn more about putting in the proper legal framework around DAOs. We are working on a couple of recent pieces of legislation. Last year, the legislature passed the Wyoming Stable Token Act, which authorized the state of Wyoming through a commission to explore issuing a stable coin. So it would be the first state issued stable coin. In Wyoming, we're calling it a stable token. And a piece of legislation that we're working on right now in the current session would clarify the treatment of digital assets, or any asset really, in the event of bankruptcy. So it's been a headline grabbing issue of late with the failures of financial institutions and what happens to client assets in the event of those failures. The piece of legislation that we're working on in Wyoming would make it clear from the sort of initial client agreements with the financial institution that those assets are held in trust on behalf of the client and not to be commingled with the financial institution's other assets, and providing guidance for the bankruptcy court that those assets shouldn't be drug along into the bankruptcy estate. They should remain the property of the clients. So we'll see where that piece of legislation goes. That's currently being drafted now.
It really seems like you guys are a decade ahead in terms of actually providing the regulatory structure and guidance about what's allowed and how things fit. You did mention in there the distinction that Wyoming is making between crypto securities, and I forget what you called the other category of cryptocurrencies, commodities.
Currency, securities, and tokens.
Currencies, securities, and tokens. So I imagine that's a contentious issue and probably an evolving topic. But do you feel like, since you guys have been engaging with this proactively, that you have reached a point where there is some sort of clarity that you think that other regulatory bodies should catch up to? For example, the SEC, in terms of how they're delineating these categories.
Yeah, absolutely. And it is, I guess, controversial in the sense that we've provided one set of definitions, and whether that is what becomes widely adopted is up for debate. All of our pieces of legislation, we've been, or I should say most all, we've been fine-tuning through the course of amendments in subsequent years, and we continue to do that. I do think, in fairness to the agencies, the definitions need to start with legislation, and so I think it's incumbent upon the federal legislature to get some legislation passed, such as the Lummis-Gillibrand bill that's been proposed, that would provide definitions and provide a roadmap for the agencies to then properly regulate these new assets.
Yeah, I think. Go ahead.
I was going to say the interaction between the state legislator and the federal legislator is very interesting to watch play out. We were in Houston a couple of weeks ago, and Caitlin was on stage, basically explaining the knockdown, drag-out fight the custodian has been engaged in with the Federal Reserve, and that's just observationally a really interesting point of contention that the states are having with the federal government right now. And that's the big question in my mind, is who's going to lead the way here. And as you just mentioned, there probably does need to be some definitions put forth by the federal legislator, but I'd like to think that the federalist ideals that this country was founded on are able to shine through with this particular industry, and we can have states like Wyoming lead the way. But it does seem like there is a very aggressive posture from the federal government towards states, and the custodia's battle with the Federal Reserve is really highlights that contention.
Yeah, there's an obvious tension there, and I understand the tension. I understand the motives of those that are charged with the federally chartered banking institutions and their desire to control the banking system. But I also believe that the states' rights are critically important and a critically important part of our country's history. The right for the states to maintain their dual banking system is, I think, more and more threatened every day, and we're losing a really important part of our financial history and an important part of innovation and creativity, addressing more local needs. Here in Wyoming, with kind of our background in commodities and agriculture, oil and gas, et cetera, the community banks serve an incredibly important role, and the ability to innovate and create our own banking charter should be preserved. But up to this point, the federal agencies across the board have done their best to prevent that innovation from advancing. And again, I understand the tension and I understand their motives, but it's just it's an unfortunate position that the feds have elected to take, and hopefully Caitlin's successful, hopefully Wyoming's successful.
Yeah, one thing I think worth noting, and I don't know enough about this, but I'd be curious, Joel, to if you have more specifics to go in, is around the stable token act, because I think while we don't talk a lot about stable coins, and there's some innovation there. They'd be able to interoperable, send dollars at any point, any time, day, night. But the thing we talk about on this podcast is counterparty risk and where the dollars ultimately live, and then what are the different ways that potentially you can have it seized, turned off, at loss of access. It still exists, but to the extent you do have to engage with stable coins, stable tokens, it makes a lot more sense to have it bankruptcy remote and then backed by a state versus right now what we see with the circles of the world that are JPMC tied. I think BlackRock's an investor. There's a lot of this. I think most of stable coins right now are parked in treasuries. And so there's this inherent risk of, tied to a certain asset based on the increase or decrease in the price. And are you left holding a bag of, what could be less than worth a dollar per coin or per stable token? So I'd be curious on how you guys have thought through it, because it sounds like a better model, and then where it's at. Because it seems like another version of where Wyoming is really understanding, how do you actually build the right structure for the consumer to be protected versus here, just, pile billions of dollars into this thing. And then let's hope it stays consistent with the price of the dollar.
Yeah, it's a really interesting project to have been a part of, or to be a part of. So just a little, to wind back a little bit, the history is that, so from the legislature, the commission was created. The commission is comprised of the governor, the treasurer, the secretary of state, and then the three of them in turn elected 4 subject matter experts to round out this 7-person commission. And I'm one of the 7. And so as a commission, we've been endeavoring to issue a Wyoming stable token. We hired a director about a month or 2 ago. We've engaged a law firm to help us with the sort of legal interpretations and constitutional interpretations of a state-issued stable token, and we're moving forward. There, in my mind, and I'm just one of 7 commissioners, but in my mind, I think we need to demonstrate 2 things. One is that we have a unique way in which we are viewed from a legal and regulatory perspective. So there should be no question that the Wyoming stable token is not a security, and it is not a Wyoming issued currency. It is a stable token, and there should be no kind of legal or regulatory question about that. The second thing that I think we need to demonstrate is a clear and transparent proof of reserves. Getting to your point, Michael, about some of the less than transparent and risky assets that some of the reserves have allegedly been invested in. So Wyoming would through our treasurer's office be managing the reserves in a very transparent way, providing audits and attestation of the reserves available for the token holders. So we'll see where that goes. It's I appreciate the fact that it's not a topic that you address regularly, but in some respects it is a significant innovation for people around the world to have access to essentially a U.S. dollar payment rail that they wouldn't otherwise have access to because they're blocked from either U.S. bank accounts or from holding U.S. dollars. This allows anyone with an internet connection, it potentially provides anyone with an internet connection to have access to U.S. dollars and to U.S. dollar payment rails.
Yeah, I think that's a great point. It's one I never even thought of. Like if you get censored from your JP Morgan Chase account for whatever reason, you're just out of your bank account access. And we've seen this happen time and time again, like the fact that you can have access to another banking partner or ability to get access to dollars, even as a U.S. citizen. We're seeing more and more of that happen.
Yeah, the stable tokens in general have always struck me as like an intermediary innovation. Like the metaphor that comes to mind is when we went from the digitization of information, we went from, for example, film. Back in the day, you had to go to a movie theater to watch a film, and then we had digital media, physical formats that developed, cassette, VCR tapes, and then DVDs, and that allowed for Blockbuster to develop and become a thing. But of course, that wasn't the end state of this digitization of information. That was a stepping stone, and it ends in digital streaming. And to me, the stable coins, stable tokens, seem like a innovation that allows for like a new form of rail for dollar settlements, when ultimately this may, the digitization of value may be leading to a more transformative and comprehensive overhaul of what form of currency are you using as your savings account and transacting in my opinion, ending up in Bitcoin being the preferred savings account for folks that they would then use the Lightning Network and so on to transact in. But of course, that there's plenty of room for massive innovation and transformation of existing rails in the meantime, with this intermediary stepping stone phase of stablecoins, leveraging blockchains and connecting that to dollars, which is still what the world wants. It seems like that's going to be a mega trend for the next couple decades, even though I think ultimately Bitcoin supersedes them.
I think that's a great point. And without making a judgment on what our ultimate reserve currency is in this world, it would appear, at least in the near to medium term, that people are going to want US dollars, and people need US dollars. And as a result, I think that while we wait for the world's sort of ultimate decision on what is the best store of value and what is the best kind of reserve currency, while we wait for that to happen, there's no doubt that the demand for U.S. dollars will continue to be significant, if not potentially grow, with the adoption of U.S. dollar-backed stable tokens. And again, it's serving a lot of people in a very important way, in providing them access to the dollar and to payment services that they wouldn't otherwise have access to. And it's some really interesting stats that our friend Nick Carter shared with me, which just goes to the point that the market cap of stable tokens or stable coins might be relatively small in comparison to crypto generally, the other layer one tokens. But if you look at the velocity, the transaction volume, and sort of the dollar velocity, stable coins are actually a significant share of the market. 70-80% now of the velocity of digital assets is in stable coins. Wow. It's a really I think your point was a good one. I think it's a really important intermediary step that probably becomes the way that we digitize the dollar, because again, this is just one person's opinion, but I don't think that a central bank digital currency is tenable in the United States. I think the ability to censor is too great for the U.S. to accept, and so I don't see that happening in the U.S. And therefore, I think that stable tokens or some derivation of that in the future is likely how we digitize the dollar.
Go ahead, Marty.
I was going to say it's very interesting because it puts the U.S. government particularly in this weird position where the success of stablecoins has acutely highlighted that there's a lot of demand for the dollar globally, and the innovation of sending these stablecoins over these blockchains is undeniable. The quickness of settlement, the ability to send it internationally at a moment's notice is a step function improvement in the wiring infrastructure that exists today. But with that being said, to date, the people leading the charge in the stablecoin world are what we would deem in a lot of way pirates that really operate outside the purview of the U.S. government, Tether obviously being the biggest example, the largest stablecoin in the world. And now they have a massive treasury balance sheet, which holds a lot of treasuries. So they're somewhat systemically tied, not systemically, but if they grow large enough,
they're a great bidder for U.S. treasuries. It's in the interest of the treasury. Yeah.
The point being is that the U.S. government's in this awkward position where it's obvious there's a lot of demand for dollars. Stablecoins are providing utility that helps supply that demand with dollars internationally, and yet they don't have complete control over it. So I think that's the big question with stablecoins, stable tokens moving forward, is how does that particular market vertical evolve? As much as the government would like all these stablecoins to be very tightly regulated, it seems like the free market is like, hey, we prefer these stablecoins provided by what you may deem as pirates.
As shown by the price of Tether historically. I did a deep dive on this like 4 years ago. And historically, the average price of Tether is like $1.001, which is to say that there is a tiny premium for Tether because it allows access to people who are unbanked. And so that's your way to hold dollars. And it also, there's a little bit of a desirable quality for the pirate nature of Tether, in the sense that it's less censorable than dollars held in a bank account. And that's desirable to some people. So it's a funny thing that, like, because they're outside of playing completely nice with the U.S. banking system, the market has actually showed a vote of confidence or a desire for those attributes, which is pretty funny.
Well, it's basically a utility function, right? Like Bitcoin's price appreciation is that desirable aspect of its utility against other, currencies. But I think what's so fascinating, it hadn't dawned on me, is we have a lot of discussions here about, this intermediary part is a part that, like, we is probably the most important, because you can't get to the end state without getting through the intermediary, and like, what are the trade-offs? And this CBDC, like, we effectively already are on digital tokens, if we think about it, where they're just like really crappy because we can only send them between 9 to 5, and it costs $20, and it gets a black box, you don't know when it's going to land, and so it's a wire, it's the banking system, and so tokens start to add to like the whatever the crypto, why there's been demand for USDC and Tether have provided utility there. And I think we all agree, and the market's probably starting to agree, that like we go to this interoperable nature, and it provides more utility, and we're seeing more of it globally. The problem is, as we've seen with the SVBs of the world, and I don't want to put Binance there because Binance has been fine, but FTXs is in this new world, counterparty risk and brand identity starts to matter, because failure actually can really happen. Failure is like a thing that historically we've seen with banks. It's like, okay, somebody gets bailed out, I'm made whole, but this whole like wild west of digital assets goes back to what we start to talk about of like free banking and reputation. And it's like, well, okay, so if we're going to a world where you're using these tokens, and now to Jesse's point, well, Tether has certain attributes. Well, what better counterparty than is there a state as your free bank, or the state backing your token, which hadn't really dawned on me. I always thought of like, okay, we'll have JPMC and their consortium of who they hold the coin. And maybe it's another firm that establishes it, similar to free banking on the currency. But what if it's a state that's making you whole, or saying that these dollars are backed here, and if it ever fails or there's ever a question, we'll be able to make that. That seems a lot more interesting in my mind than going to a third party that's a private entity. And I think to the last point, like where Joel was referencing, is with this intermediary part, it's like we have trillions of dollars that have to get in. And so there's going to be some form of intermediary spot, whether it's through bank wires or stable coins, that are going to be held. Depending on the period, that's up to the end person and where they're moving assets and how they're thinking about into Bitcoin or anything else. But these will be a functioning part for the next 10 years, at least in my mind, of how like people will transition over from like analog to this quasi-digital currency before moving into Bitcoin.
Yeah, those are all great points. I agree. And you can see it's being done somewhat quietly, but you can see among the existing payment networks how much activity is taking place to essentially create private loops of their own stable coins. So, Onyx at JP Morgan, PayPal has issued its own stable coin. Visa has numerous different initiatives that they're working on. Citibank has some initiatives that they're working on. I saw an announcement recently out of Deutsche Bank that they're working on something. So the idea of tokenizing deposits or tokenizing trade, letters of credit or trade credit, it's all sort of the same idea. It's using distributed ledger technology to create a more efficient payment rail that's backed by some asset, US dollar reserve or otherwise, and it just is the best way to do that through a private network controlled by one private institution is the best way to do that through a state, or is it through federally issued tokens such as a CBDC? So I think that we're gonna get to watch that from the front row over the next few years, how that plays out.
Yeah, it's exciting that it is kind of free market capitalism right now in terms of all these various stable token products coming to market, and make no mistake, they're coming to market right now because of how profitable it is to hold treasuries.
Right.
And if you ingest a dollar and turn that into a treasury yielding 5%, but you're promising a dollar back to the holder of that token, you're minting money, and that's what Tether has stumbled into now, as interest rates have risen, and every bank would love this to stand up a new product line, a new vertical to mint money in this new exotic way. So we get to benefit from watching that free market fight play out, and in my opinion, hopefully that free market landscape continues to evolve without the government coming in and saying, no, you're not allowed to. It's going to be a singular CBDC, because I believe the free market delivers the best forms of innovation, and so it's exciting on that front. Joel, I wanted to ask about
real quick, Jesse. Before
Go ahead.
Just one thing. Did we just stumble on how Bitcoin becomes like a global reserve asset? Because as I was thinking about this, it was like, well, if you're going to back it by dollars, and then eventually if the dollar's depreciating or reputational, like somebody doesn't make you whole, then you leave that system and you go to the next partner. It's like, well, then maybe you want a better asset to back at 20%, 10%. And then I was thinking, well, who would do that? It's like, well, Wyoming would probably do it first to have 20% in BTC and then 80% dollars. Like starting to think through. But if that ultimately is where this goes, then that's how you start to build the credibility of, if that's where this heads, and you build the credibility of your dollar backing into, and then it goes from a 1% allocation to basically it's 100% backed by Bitcoin.
Well, I think to that point, Jesse, what you're saying about entities like Tether holding treasuries on their balance sheet and minting free profit as their stable coins are only redeemable for $1, 1-to-1. That's could be a ticking time bomb too if U.S. Treasuries, the demand for them internationally begins to wane materially, which seems like it may be happening. Like you find the situation where it's a good trade now, but it potentially may not be 2 years, 3 years down the line. As we know, rates are up above 5%. We need to refinance a third of our national debt over the next 2 years. How does the market react to that? Does a recession come quick enough to justify a lowering of rates, which makes that refinancing of all that debt more palatable? There's a lot of these questions and landmines on the horizon that I can see.
Yeah, I think in like Tether's business model, you have to hold to maturity to make that make sense, because you can't be like selling, like when interest rates rise and then suddenly the value of the treasuries you're holding drops, you can't realize that loss. You have to hold to maturity. So I think they probably have to do that, and they're probably banking on enough demand for the number of Tether in existence just keeps going up and to the right. So you can sit on your older treasury bonds into maturity while buying new ones, which are issued at the increasingly higher rate as that spiral plays out, and the yield the market requires for holding a treasury bond increases, then Tether benefits from that. The irony there is that the user of the Tether is the one who is losing out the most, because they gain the benefits of this payment rail, but they suffer the debasement of the value of their Tether, their US dollar, without getting the benefits of holding US treasuries. So it's kind of funny that to Michael's point, that might be how you backdoor into, some entities offering up stable coins that are increasingly backed by Bitcoin. And if you can if you have the bankroll to withstand the volatility that comes with that ends up outperforming even the US Treasury scenario, in the assumption that we're entering a period of inflation greater than the yield on U.S. Treasuries, because that has to happen in order to inflate away the debt. All fascinating.
Yeah, you can see yourself blending. Yeah, we kind of went off the rails, but you can see how that you would blend part of the Treasury return coupled with the Bitcoin allocation. So it's not an offset if you like if you're being, and this is kind of like the battery stuff.
Yeah, you're validating something we've been debating for like 6 months.
Yeah, but this is like this is state level. This isn't a private. This would be like, but yeah, I hear
you. And that sort of brings me back to the thing that I was going to ask Joel was, in thinking about this, like, Michael talked about, and Marty talked about interstate jurisdictional arbitrage, and we're seeing international plays, El Salvador, trying to become a home of innovation for Bitcoin in particular. And do you see this as like a major initiative for Wyoming to differentiate itself in terms of the future of commerce in the state versus other states? And what comes to mind is the various efforts that California made to make California the native home of the internet, or even Delaware to be the home of corporations. Is this a play that Wyoming is setting itself up to be a major player in this landscape for the 21st century?
That's certainly the motivation for the state to be proactive around the legislation and regulation of this asset class. But I think it's kind of just one layer of multiple reasons why Wyoming becomes an attractive place for either builders or investors in digital assets. In addition to the sort of forward-thinking legislation and the thoughtful regulation, I mentioned we've also stood up recently the new Chancery Court. But you also combine that with the Wyoming LLC laws. The Wyoming has among the best, if not the very best, privacy laws in the United States, asset protection and creditor protection laws, and no personal or corporate income tax. In addition to capital gains and trust and estate tax. So there's very, very low taxes in the state of Wyoming as well. So this is, to me, just kind of one more reason why, if you're building in this space or you're investing in this space, Wyoming becomes a very logical place in which to do that.
Thank God for Wyoming. We need no, it's truly important. I think that's one thing historically in Bitcoin. If you have this massive opportunity, the whole conversation we're having around regulation is important, but it's also funny because we have this incredible technology at our fingertips that allows us to erect a new financial system with properties that are, again, a step function improvement on the incumbent system that we're trying to transition away from. And yet there are regulators at the federal level really don't get it, and even at individual state levels that don't seem to get it, or their donors line their pockets in a way that makes it so they will never get it. And it's a big confidence game at the end of the day, in my opinion, particularly with this interstate jurisdictional arbitrage. We need states like Wyoming, Texas, Tennessee, Florida to stick their necks out and say, no, we're going to be open to business here. We're going to allow people to innovate. We're going to allow the free market to lead this innovation, because we recognize that the state is not going to be leading this innovation. And I don't think it should be discounted, the act of sticking the flag out there. It just instills confidence in others to say, hey, they're doing this. Wyoming's seeing a lot of success and bringing in a lot of businesses into their borders. And Joel, on that note, I just want to thank you for all the work that you and the committee have done to really stick your necks out and push this forward, just, if anything, to instill confidence in other states. And on that note, do you view what the committee has put forth in Wyoming is a blueprint for other states to adopt, or are there more intricate nuances at individual state levels that would prevent somebody from adopting this as a blueprint?
No, I would hope that, and we would hope that other states will adopt what Wyoming has done, and that's already happening. We're seeing it with other states, and Texas is making a great name for itself in doing a lot of the similar work that Wyoming has done, and we hope that. Honestly, I don't sort of come at this. I have a traditional finance background. We're on the private sector side. We're building a firm that is very much meant to look and feel like bringing digital assets into a traditional finance platform. And I'm hopeful that there will be federal regulation at someday. I hope it's thoughtful, but I think that having legal clarity and federal regulatory oversight is critical for the U.S. to remain competitive in innovation, and it's critical for the success of this asset class. And I just to get kind of technical for a second on, we just look at the price of crypto since the Binance overhang has been removed from the market. So, I think the more clarity we get from regulators, the healthier this asset class is going to be. Now, there could be, and they could overshoot in some way and screw it up, but I have faith in the process that eventually they're going to get this right, and this innovation, and they should, and that's going to position the U.S. In a great place. I just hope they hurry.
Yeah. I totally agree. I hope that the U.S. gets to enjoy the same benefits of being the home of the internet, with blockchain, Bitcoin in particular. And yeah, it
would be the biggest fumble of all time. I mean, American citizens hold the most amount of Bitcoin compared to the rest of the world. And individually.
I'll say something a little controversial in the Bitcoin community. I don't think it's, I think that's part of what Onramp is embracing or accepting, is that my view is that for Bitcoin to become the path for Bitcoin to win, it involves embracing some amount of regulation in order for the mainstream to be comfortable enough to adopt it. Because that's how it ends up in people's pensions and people's 401ks, and that is antithetical to what the earliest crypto anarchist adopters would like, and there's this sort of vestigial belief that if we hold out and everyone will have to bend the knee entirely to Bitcoin. That might be right. That might happen if there's absolutely no compromise whatsoever and Bitcoin's mechanics continue to play out and the dollar continues to debase. However, I think there's greater risk in that path because of the possibility of persecution or draconian backlash when Bitcoin wins without any sort of regulation. And so I think incorporating regulation and part of that is increasing adoption among regulators and senators. I think that is a path, a more conservative path that involves some amount of compromise, but really it's about evolving. It's about growing into the type of asset that the mainstream needs Bitcoin to be in order to have it on their balance sheet. And so, I think it's a bit of a controversial statement in the Bitcoin community, but I think that regulation is some amount of regulation, and hopefully it's the Wyoming type of regulation, is Bitcoin's best path to success.
Yeah, and just to add to the controversial statement, I'll go even further and say it's the only way Bitcoin succeeds is through regulation. And the reason why is from an order of operations, the way they get the capital in is through a framework and structure. Now, on the other side of it, are they going to be happy with what they unlock in its permissionless nature? Probably not, but that's on them. Like we need to play the part. We have to do the things. We have to create the products and vehicles to get capital in. And then on the other side of it, what they think they're creating or going to control, I think TBD on how that ends up. But I think that's an important function that Jesse's outlined is like we have to make this look. Like, we talk about this backing into Bitcoin as a reserve asset. It's like, well, stable coins are here. Eventually people wake up and it's like, well, what am I holding? Maybe I need to juice the return a little bit. Now your base is 99.1 and over time it's 10%. And next thing you know, it's just accepted that this thing is backed by Bitcoin. And then maybe you're using Bitcoin over time. And maybe that's 30 years from now, but you can start to see a framework for how that actually happens. And there's trillions, hundreds of trillions of dollars of capital that have to flow from the hard asset or whatever the asset is into some intermediary, into BTC. And that's where all these things have to coexist. There's no world where hundreds of trillions of dollars just jump into Bitcoin and you're just like, oh, good. Now we're good to go.
Right. Yeah. And there needs to be regulatory framework for people to hold those stable tokens comfortably. But Marty disagrees.
Yeah, I wholeheartedly disagree. This is define it as money. Let the free market take it. I mean, there's already pensions holding Bitcoin. There's already endowments holding Bitcoin. Like, if you have the will, you will find the way. Many people have done it already. Billions of dollars worth of capital has been allocated to Bitcoin on behalf of institutions. It's just, you have the wimps out there that are waiting for daddy government to give them the okay. I don't think you should wait for that, because if you give them the okay, they're going to want their cut, and their cut's going to be too big.
Marty, do you think there's a greater chance of persecution or draconian backlash with your preferred path?
Certainly, but if Bitcoin's going to succeed to the level that we hope it will succeed, people need to grow some nuts and realize that when laws are unjust, they should not be followed. You need, again, to step up, instill confidence in others, and say this government's turned into a tyrannical operation. It's just wholeheartedly. We have what is going on right now at the federal level with all the printing of the debt. We're at the looting the treasury stage of the end of the empire. You should not bend the knee to these drunken tyrants who are drunk on debt, and they need a way out of that debt problem. Bitcoin's going to be a good way out, and I think we should push back against the regulators and hand the decisions back to the states as much as possible.
Right. Maybe that's the form of battle that is worth fighting.
The Stanford MBAs aren't willing to fight,
The Stanford MBAs are generally not willing to fight this battle. I kid. Oh no, it's entirely true. The Stanford MBAs are, still living in the Obama optimism about the federal role, and I think that I sure hope that we get some more free market competition from Wyoming to Tether to El Salvador. You have these different forms of experimentation that are happening and only possible if you don't have a top-down dictate from a singular entity telling you how things are going to be. On that front, I agree, Marty.
Who's going to end up telling us how it's going to be? It's Elizabeth Warren.
All right, we should transition. We should transition to the.
I'm sorry.
It's not the.
Joel, I didn't make you aware, but my oldest hopped into bed with me at 3 a.m. and I went to bed at 12:30. So I'm going on 2.5 hours of sleep, riled up.
Marty's alter ego's coming out.
Topic for Matt too.
Thanks for tuning in to The Last Trade. If you're enjoying the show and want to dive deeper, check us out at onrampbitcoin.com, where you'll find a full suite of institutional-grade research and analytics, including our recently published white paper, Bitcoin's Full Potential Valuation, and our new tool, the Onramp Terminal. Now, back to the show.
No, this is a good transitionary period to talk about Two Oceans Trust and what you guys are doing. I mean, this is the service that Two Ocean offers to your clients is probably one of the last bastions for individuals, particularly high net worth individuals, to protect their wealth in a world that's getting increasingly chaotic.
Yeah, and actually, just to add to that one part of like tying the last segment into this is, sorry, I have a dog. I don't know if you can hear it, but it's basically like high net worth individuals and capital coming in. If you don't have a framework for how do you legacy plan, they just won't come in. We know some of them, Marty, like ourselves, that have hundreds of millions of dollars, that unless they know how to put the capital, the Bitcoin from a custody perspective, but that's only half of the battle, and knowing who your counterparty is there, because we know how that's important. But then the secondary part is, well, what is the framework? How do you map the existing framework from revocable trust, irrevocable trust, and legacy planning to this new asset so that it's there if it's a generational asset like we all believe? And if that's not there, then people's capital doesn't come in. And so, not to tie back to that conversation, but tie it to what Joel's doing, is why it's important to bring the framework from the old world, the traditional world, and how do you map it to this asset in a professional way so these individuals can come in and actually plan around it.
Right. Yeah. Well, and there's an interesting tension that exists between the traditional way of managing assets through generations, which we have sort of trust and estate planning, and there's a sort of an inherent tension between that and this original ethos of crypto being a self-sovereign asset. And the reason is because to unlock the benefits that come from strategic planning, and those benefits are, kind of clear succession planning, avoiding probate, minimizing your tax hit from kind of a trust and estate planning perspective. So that can be done at a state level. That can also, you have the federal gift tax exemption, the privacy and the creditor protection. All of those benefits are unlocked through kind of sophisticated strategic planning, but requires that the individual setting up these plans relinquish some level of control over the asset. And that's that kind of inherent tension against this notion that it's a self-sovereign asset. So that's the fun stuff that we get to explore with clients on a daily basis.
Yeah, and how have you seen that? Like, I guess there's really the two sides of the market that you serve is the existing client, which is probably easier, right? Because it's like, this is like every other asset. Here's your counterparty. Here's where it's stored. But then it's really that area of the market that comes in that's native, that has accrued wealth. That's like, wait, now you want to, take delivery or position where the asset's custody because of the actual like legal requirements from setting up trust. And how does that conversation generally go?
Yeah, so as you pointed out, they're kind of overgeneralizing here, but there are sort of two client types that we work with. The first is call it kind of crypto native client, who they've created their wealth through crypto, and there's really not a learning curve around the asset itself, but they're again, gross overgeneralization here, but there may be less understanding or less education around succession planning and being thoughtful about asset protection and tax planning. And so that's that kind of tension that exists, which is getting those clients comfortable with the idea of a sort of more institutional approach to custody and introducing a third-party trustee into that relationship, which is necessary to unlock those benefits. On the other hand, we have clients that have come from kind of traditional wealth generation that are looking at this asset class for the first time. They understand the sort of need for trust and estate planning, for succession planning, for asset protection, but have questions around the digital assets. How safe are these assets? How safe is the custody? Can my portfolio withstand the volatility that's inherent in the prices of these assets? And so there's two very different conversations that we're having with these two types of clients.
And on that last note on performance, I think it's a good opportunity to pull up the research piece, if you have it handy, Logan, to really dive into these numbers. We were discussing it before we hit record, but we talk about these numbers a lot within the Bitcoin industry, but it seems like there's still a disconnect between the return profile of Bitcoin historically and the understanding of that return profile in the investment management space.
And Marty, what is this document we're looking at?
It is the revisiting the case for Bitcoin, which is a letter, a blog post put out by Two Ocean, Joel?
Yeah, maybe Joel.
Piece we wrote back in May. It was actually a follow-on piece to the original piece we'd done a year previously, and the catalyst for it was the crypto winter, the big sell-off in digital assets, and so we thought it would be interesting to go back and revisit the analysis we had done in light of the sell-off. So if you dial the clock back to May, Bitcoin and the various other crypto were near their lows, and despite that fact, there was still a very compelling argument for the inclusion of, in the case of this paper, it's Bitcoin that we focused on. So a very, very strong argument for the inclusion of Bitcoin in a traditional diversified portfolio. And
what are the advantages there, Joel?
Yeah, so twofold, really. There's one is the performance of Bitcoin, and I think you had a table up that you were just showing. But if you look at the price of Bitcoin relative to, that's it, relative to gold or relative to the S&P 500, back over a 3-year, a 5-year, or a 10-year period, even back in May when it was well off from its highs, Bitcoin was well off from its highs, it had still, on a compounded annual basis, significantly outperformed these other traditional asset classes. So that's kind of number one. And then number two, which I think is a very much misunderstood part of the argument. Well, here, let me, just because you've got it up on the screen, let me jump back and just, if you keep it right on that chart. This is an analysis we did, which is we started with a traditional 60% equities, 40% fixed income portfolio. That's on the far left of the x-axis. So 0% Bitcoin, 60-40 portfolio. And the three lines represent 3-year, 5-year, and 10-year compounded annual returns. And then we reran the analysis, adding 10 basis point positions to Bitcoin up to a 10% position in Bitcoin. And you can see the significant impact that the allocation to Bitcoin had on a historical basis. Even a small allocation, like say 5% allocation to Bitcoin on a 10-year basis, almost doubled the returns, the annualized returns. Yeah. And again, that was when prices were significantly lower than they had been or where they are today. So the second argument here is volatility. And this is the piece that I was mentioning is somewhat misunderstood. Bitcoin, to be sure, is a volatile asset, and it's more volatile than the other traditional asset classes. However, because it has carried historically a very low correlation with traditional asset classes, adding a portion of Bitcoin to a diversified portfolio, at the levels we were talking about, between sort of 0 and 10%, not only didn't increase the volatility of the portfolio, but in some of the smaller allocation amounts, it actually decreased the overall volatility of the portfolio. So even though you're adding a more volatile asset, because of the lack of correlation to the other assets in the portfolio, the overall portfolio volatility actually decreased. And for those that spend their time looking at these sorts of things, you'd be familiar with the Sharpe ratio, which is a measurement of return versus a unit of risk. So it's in my opinion the best measurement for risk-adjusted returns. And this is a Sharpe ratio, so 36-month trailing or 3-year trailing Sharpe ratio, which is the amount of return you generated over the preceding 3 years versus the amount of risk that you assumed during that period of time. And the higher the Sharpe ratio, the better. And a benchmark generally is you want to generate a Sharpe ratio consistently greater than 1. So with Bitcoin, this is just Bitcoin alone. You can see the Sharpe ratio has been historically above the orange line here, which is the 1.0 Sharpe ratio horizon. 77% of the observed periods, you would have generated a Sharpe ratio greater than 1. And the median of these observations was a 1.6, which in and of itself is a fantastic Sharpe ratio. Just owning Bitcoin has generated a much better Sharpe ratio than traditional assets. And so as a comparison, and generally you kind of think of the market as being around a 1 Sharpe, but that 60-40 portfolio that I mentioned earlier was, it tends to bounce around that 1 mark. So Bitcoin all by itself has generated better median Sharpe ratios over time. But when you add it to the 60-40 portfolio, and this graph you've just pulled up here shows that same concept, which is the far left of the x-axis is 60% equities, 40% fixed income. And then as you move across to the right, we're adding incremental allocations to Bitcoin. You can see what happens to the 60-40 portfolio to the Sharpe ratio by adding these small increments of Bitcoin. And this is not for your Bitcoin maxi crowd, but if you're thinking about a traditional wealth manager or a traditional high net worth family, and you look at the gain in Sharpe ratio that you can pick up from going from 0 to just a 2 or a 3% position. What you've done here historically is you've actually decreased your volatility and substantially increased your returns by adding a small portion of Bitcoin to a diversified portfolio. And again, looking at the 10-year or the blue line on this graph, going from a 10-year historical Sharpe ratio of 0.77 up to a 1, that's a very meaningful. And again, that was at a point in time when Bitcoin was on its lows. So we'll redo this analysis maybe at 1 year again, and it's just interesting to watch this over time. But a very compelling argument for traditional wealth managers, for traditional high net worth individuals, or just investors in general, to consider adding a small portion of Bitcoin to a portfolio.
Yeah, that's the most comprehensive Sharpe ratio analysis I've seen with Bitcoin, and it presents the whole case. I particularly like how you break out, because too often it's just the Sharpe ratio, but you broke out, here's the performance side of it, and you see that on the graph. It's quite linear. Increase of Bitcoin allocation results in better portfolio performance over all of your selected time periods. I guess that's how BlackRock ended up running a similar sort of analysis and landing on the optimal allocation to Bitcoin is 86% or whatever it was, because that's, that math plays out in that way. So you got the pure performance of it, but the volatility piece and doing the analysis of just volatility and how increasing a percent or two allocation to Bitcoin decreases overall portfolio volatility. That's the holy grail. That's everything that you're looking for in portfolio construction, and all wealth managers have to do is just read this analysis in order to understand the case for Bitcoin in a well-rounded portfolio.
It's fascinating.
Yeah, Joel,
it's so counterintuitive to the narrative around Bitcoin. Yes, Bitcoin in isolation is highly volatile, but as the pure Bitcoin chart showed, the median Sharpe ratio is well above 1. But you can see if people don't really dive deep into what's actually happening here and they just look at it at a surface level, they can see the volatility and maybe assume that it doesn't add any benefits to the Sharpe ratio of their overall portfolio.
Well, it's all about sizing too. That's just the crazy part about the volatility case. It's like just size it appropriately where the volatility doesn't matter. And then we all know once you have some exposure, it's kind of when the floodgates open. Joel, the thing that I really appreciated, I mean, it's a great report, but it was the timing of it. It's very often, it's very counter to like when you see all the education research comes out, it's when the market's flying. And I just remember it's the summer and you're building and nobody's talking about Bitcoin and there's very little research and reports. And it came out, it's like, hey guys, this is still here. This is the time you should actually be paying attention, educating yourself and also allocating. So that'll always be implanted in my head. I just remember the summer when everything was quiet and everybody's like, oh, this stuff is, nobody's talking about it. And you guys dropped that report.
A career of investing, I've developed a strong superstition around it. So I actually think I reverse jinxed the market by putting that out. That might have marked the low. So
well, we appreciate your service.
Our wives appreciate it.
Yeah, a lot better than Bank of America put out like a pet peeve analysis of mine at the very top of the last bull market. They ran their analysis on what's the multiplier of capital inflows to Bitcoin and how much each dollar of capital inflowing to Bitcoin increases the total value of all Bitcoin. And they came up with like a multiplier of like 120x, something like that. But what they're looking at is the sample of bull market mania. So, and then they're extrapolating that across time. And so, that still shows up. People say, oh, Bank of America says that every dollar that flows in increases the value of Bitcoin by $120. And that's just not true. It was true for a very finite moment in time at the worst possible point in time to be doing that analysis, which is, of course, when they did it.
Yeah. Yeah.
Well, when that analysis gets accepted is, sorry.
No, I'm sorry, Michael. I was just going to say that I think one of the important drivers of that analysis we did was correlation, and correlation itself moves over time, of course. And I think that because there is a lot of attention paid to correlation when there are drawdowns, there's a perception that Bitcoin is a risk asset. It is a risk asset, obviously, but when there is a risk event and all risk assets are sold, Bitcoin is sold, and there's a deleveraging effect that affects all risk assets. And so I think even my own perception, I think just people's perception of the correlation is much higher than it actually arithmetically is, because it's, for a couple of weeks every year, these risk assets all move in lockstep, but it's the other sort of 50 weeks out of the year and we've seen a lot of it over the last few months, haven't we, where the equity markets and crypto almost seem to be going in an inverse relationship. There really is a very, very low, sustained, very low correlation between Bitcoin and these other assets, which is a wonderful thing to have in a portfolio for generational wealth.
Yeah, I was just going to allude to what the report made me think of is we had Chris Kuiper, who leads the research team at Fidelity, on a few months ago. And this was one of the things he was really excited about once the benchmarks were established in the wealth management community of like the certain percentage allocations. And that was just like, you just check the box, is really when the floodgates, open for capital to come in. And so it's just 1% return or 2%. So it sounds like that's similar in line with your kind of like thesis on where kind of the market starts to understand, a small allocation can really outperform the market.
I think it really depends on the client, Michael. For the Bitcoin maxis, to be sure, if we extended that graph out past 10%, the returns and the Sharpe ratio keep going up and to the right. So this is not meant to. And by the way, I have an irresponsibly high allocation to Bitcoin personally. So,
Joel, I've heard it goes up for forever. I've heard it goes up forever, but I can't confirm.
So, but I think if when we're talking to clients who, our typical clients who are ultra high net worth families and foundations, and they're investing in an endowment style of investing, which is to have a diverse set of uncorrelated asset classes that will generate some income for the foundation's needs or the family's lifestyle needs, but then sort of outpace inflation over a very, very, very long period of time. That's the goal. And when you're talking to clients like that, then when you can make an argument that historically across these 3, 5, and 10-year time periods, not only are you increasing your returns significantly, your numerator, but actually at a 2 or 3% position in the portfolio, you're actually decreasing your risk, your volatility, your denominator. So that just becomes an easy argument. You're getting a win on both the numerator and the denominator if history continues to repeat itself.
Do you feel like there's been a shift, or do you see a shift coming in terms of this becoming the accepted wisdom that, the math is out there that people are at this point potentially being irresponsible for having a 0% allocation to Bitcoin when the math suggests that a 1 or 2% allocation makes a ton of sense? Do you feel like in I guess broadly in the wealth management industry that this is finally percolating through? No, I don't.
I believe it. I know you three do, and I suspect most of your listeners do. But no, there is still a healthy amount of skepticism amongst the traditional finance folks, and I think a lot of it is the narrative that the Elizabeth Warrens of the world are putting out there. It was used to fund terrorism narrative. There was a lot of publicity around that, and unfortunately, there's been very little publicity about walking back the false analysis that went into that statement. But so no, there's still a lot of skepticism I see amongst the traditional high net worth investors, but that's bullish to me. Like that's again, going back on my career, there's a couple of things that you want. You want a lot of people who are still negative on an idea, and you want volatility. And so that's these things that you might look at on the surface and say are negatives. Those actually, to me, are that's the kind of potential energy that still exists in the prices here.
Yeah, that creates the.
And Joel, what you just, I know we talked about it a little bit before the pod, but the Onramp terminal, what you just described was the genesis behind investing in that tool to showcase to institutions, wealth managers, their clients, why there's not a bunch of error between zero and the current price of Bitcoin. Because to the uninitiated, they're just looking at it, and to Marty's points, like the common trope of, past results are not indicative of future returns, or however the phrase goes. It's like that thought, that well, okay, so this is the return profile if it continues, but why would it continue? And we all know why it would, but somebody else needs to go and do that research and see all the different core fundamentals, how they're just going only in one direction, whether it's mining, hash rate, nodes, transactions. So yeah, we'll get you over that access because we'd be curious as you think about it from an institutional perspective, what are other metrics that individuals you think are going to be interested in seeing we can start to incorporate to give like the right tooling to the market?
Yeah, Michael, I'm happy you brought that up because I wanted to interject and say, yeah, let's steel man this. Like past performance is not indicative of future returns, but like just look at the setup here. I think the estimates are like 80 to 150 million people globally have adopted Bitcoin in earnest. That's a very small percentage and probably overestimating the total amount of people who actually hold Bitcoin. We're still very early in this. There's 8 billion people on the planet. Governments are proving to continue to be fiscally irresponsible moving into the future. The world is becoming more interconnected. You have this peer-to-peer digital cash system that can connect the world. And then on top of that, I really don't think, and Jesse, this is your favorite topic, but people don't understand how many Bitcoin has already been distributed in the market and the fact that we have another halving coming up in 5 months that's going to reduce the supply inflation that's being introduced to the market every block. And those factors, whether people want to recognize it or not, more and more people are learning about Bitcoin, becoming more confident in it, putting their savings in it. There's less Bitcoin being distributed to market, and governments are proving to be woefully irresponsible with their fiscal policies.
Yeah, and I also would add to that, very good list of kind of the bull case thesis. I would add to that I do think that legislation and regulation, it's grinding slowly, but it is going in the right direction. And the Lummis-Gillibrand bill is, maybe it doesn't pass in the near term, maybe it doesn't pass in its current incarnation, but I think that it will eventually. I think that we'll probably see stable token legislation soon, in the next year. And I think that over the course of the next year, we're probably also going to see a spot ETF approved. And so it's for our clients who are investing for periods that are in kind of decades. And you think about what's going to happen from a legal and a regulatory perspective, it is damn near inevitable. And once that happens, then I think the opportunity for these handful of digital assets is significant. And I think, but my personal view on Bitcoin is that maybe it doesn't replace the dollar in my lifetime. As a reserve currency, I think the importance of the dollar is demonstrating that it's sustainable. But I do think that it replaces gold for sure. I think it becomes the reserve asset of choice for investors looking for a hedge. And I think, I don't know if it's Ethereum or something like it that's programmable, that you kind of think of not as a currency or as a store of value like Bitcoin. I think you think about it as an operating system. So in the same way that we sort of look at investing in Microsoft today, I think that's how we'll think about protocols like Ethereum. It's an operating system. It's a program. And so these digital assets, I think, have a very asymmetric setup right now for all the reasons you listed.
Joel, from your cohort from a previous life, what percentage do you believe knows that there's only 21 million Bitcoin? I think this answer is one of the most bullish things. Yeah, it's only about 30%, and that probably is being very kind. I think that a fifth to a third of the market at best, who's controlling capital, knows that there's only 21 million Bitcoin. if that's not bullish, I don't know what is.
Right.
Yeah, and probably 10% of those won't realize that 19.5 million have been distributed to the market already.
Right.
And very few realize there's a halving coming, which is the most exciting part.
We have to really figure out our halving event.
Efficient market theory, doesn't it? When
it sure does.
Everybody knows it's going to happen, and then it happens, and it goes up, and it's like,
yep,
that wasn't supposed to happen.
I was taught at Stanford. They taught us weak form efficient market hypothesis, and I always thought that something was off about this because, how was anybody a better than average investor? How did Stan Druckenmiller do so well for decades if there was a level playing field and all information was incorporated into prices accurately? That's just not reality. That's not human nature. And then here comes Bitcoin to like amplify this this problem. And sure, it manifests as understanding asymmetry, but that the efficient market hypothesis doesn't allow for understanding asymmetry. And so, boom, it's a shot across the bow for that whole hypothesis. And yeah.
Joel, what we learned last week, it was new knowledge to Marty and myself, is that the halving is like Christmas to Jesse. And so now we have to figure out what our halving event will be, because it's going to have to be special. We can't let every 4-year Christmas come and go without doing something special. So we'll have to plan around that. We'll let you know.
I'll make a note in my calendar to send you guys a fruitcake.
That would be amazing.
There's a lot of people planning halving parties already. I'm like, hey, see how much hash rate's coming on the network? You're gonna be having a late halving party by the time it comes. It's actually the market update of the week. I read a newsletter last night. It is. I know we talked a lot about mining last week, Jesse, but I didn't run the numbers on the hash rate growth. Hash rate has grown 27% in less than 3 months between September 6th and last week. It grew from like 383 exahash a second to 450 something, I believe.
Brutal for miners. And another incredible example of there's a fully transparent metric that shows you what people are doing with their dollars, their CapEx spend right now. They are investing in this thing, and you don't get that in any other asset class. You don't get to see transparently what's really happening in terms of investment into gold or any other commodity. You piece it together, but here it is, unfudgeable.
Yeah, and I mean,
Logan,
just
can
to
you bring that one up? That would be interesting to just throw up, because I just pulled it up. I hadn't seen that. Look at the miner revenue.
Yeah, miner revenue's going up. It was above 40 million temporarily with the mempool congestion last week or a couple weeks ago. But no, just to put this in context, 27% growth in less than 3 months. What took 14 years and 8 months to get to a certain point, the network just added more than a quarter of that in less than 3 months. It's pretty insane.
Yeah.
Like a U.S. government debt.
Yes. Yeah, we 6 trillion annualized over the last few months in additional debt. Incredible. Surely sustainable.
Very scary.
Yeah.
It's we don't have to dive. That'll be a whole another half-hour discussion that we don't have time for. But I think people are expecting it to go longer than it may go. The debt situation. That's all I'll say about that. But Joel, thank you so much for your time today. It's been an incredible discussion. Your experience in the traditional finance world and now the work that you've done at Wyoming in Two Ocean is extremely insightful. And I think the listeners of the show are going to get a lot of value out of this conversation.
Well, thank you. You're generous with your compliments. I appreciate having this chance to chat with you guys. Thanks for including me.
Yeah, and I just want to apologize for letting the tiger out of the cage earlier. Going a little sleep. It's good to have that back and forth, though.
It's good to have a little spice in any podcast.
Yeah, that was great. No, Joel, appreciate you joining. And I think there's really a need. It's something we're trying to embody at Onramp of like I don't know if professionalizing is the right word. Maybe it is, but it's just thinking about how do we bring these concepts to the market in the way that they want and meeting them where they are, whether it's through custody, education, or conversations like this. I think that they're really rare, and it's just because we're so early. There's nothing really special about us. It's more that we're just early, so putting all this together. Right now, it's a little bit foreign, but over time, it'll just continue to be the norm. So I appreciate you joining and coming on and giving us your kind of expertise with the space.
I appreciate what you guys are doing too. Thanks for including me.
All right.
Thanks, Joel.
We'll see everybody next week.